Investing might be one of the more difficult ideas to grasp in personal finance. However, it is also one of the most important pillars of financial independence and wealth creation. In this video we'll take a look at how to invest in stocks for beginners. Before starting this video, like it and subscribe to our channel for more videos. How to start investing. Investing is the act of choosing where you want to go in your financial journey and connecting your objectives to the appropriate assets to help you get there. Understanding your connection with risk and managing it over time is part of this. You just need to leap in once you know what you want. You may choose to invest on your own or with the help of a financial planner. Each of the major stages to getting started with investing is discussed in full here. Number 1. Decide your investment goals. Before you create an account and start researching investing possibilities, you should think about your overall objectives. Is your goal to invest for the long term or to create income from your portfolio? Knowing this reduces the number of possible investment possibilities and simplifies the investing process. Understanding your objectives and timetables can help you evaluate how much risk you can tolerate and which investment accounts should be prioritized. For example, if you wish to save for retirement, you should use a tax-advantaged vehicle such as an individual retirement account, IRA, or a 401k, if your company provides one. However, you may not want to put all of your money set aside for investment into a 401k, since you cannot access that money until you are 59 and 12 years old, or you may be slapped with penalty costs, with a few exceptions. You also do not want to put your emergency fund in a brokerage account since it is difficult to obtain money fast if you need it. Furthermore, if you need cash during a market slump, you may wind up losing money if you are obliged to sell cheaply. Number 2. Select investment vehicle. You must choose which investment vehicles, also referred to as investing accounts, to employ after deciding on your goals. Remember that many accounts may cooperate to complete a single task. A brokerage account is the best place to start if you want to develop your portfolio more actively. You may purchase and sell stocks, mutual funds, and ETFs using brokerage accounts. Because there are no restrictions on your ability to invest, your income, or the amount you can withdraw, they provide a great deal of freedom. You do not enjoy the same tax benefits as retirement funds, which is a disadvantage. Several financial institutions, including Hotlink Ignore Equals True, Charles Schwab, Fidelity, Vanguard, and Hotlink Ignore Equals True, TD Ameritrade, provide brokerage accounts. Working with a conventional brokerage often offers the advantages of having access to various account kinds, such as IRAs or custodial accounts for kids, as well as the ability to contact a representative by phone and, in some circumstances, in person, if necessary. With any issues, however, there are drawbacks. Some conventional brokerages could take a little longer to implement new functions or specialized investing choices like cryptocurrency. For instance, years before conventional brokerages did, fintech firms like Robinhood and M1 Finance offered investors fractional shares. A robo-advisor is another choice for a brokerage account, and it is excellent for those who have precise, unambiguous investment objectives. Lower costs compared to a human financial advisor and automated rebalancing is only a few of the benefits of employing robo-advisors. A robo-advisor may not be the ideal choice if you have more complicated financial objectives and want more specialized investment alternatives. One thing to keep in mind is that opening a brokerage account and depositing funds is not the same as investing. The next step is to make a purchase, but novice investors sometimes believe that creating an account and contributing funds is sufficient. If you are enjoying watching this video, give this video a thumbs up and subscribe to our channel. Number 3. Calculate how much money you want to invest. You should think about how much money you will be putting in each form of investment account as you choose which ones to start. The amount you may invest in a certain account may have a cap. Starting small, even at only 1%, is okay. It is crucial to start so that your money may increase over time. Cost averaging may be a successful investment strategy, but it has drawbacks as well. You are more likely to earn a bigger return if you invested a lump amount at the beginning. It is still advantageous to keep contributing to your assets regularly even if you choose to invest a big amount. Your portfolio will have more opportunities to expand if you do this. Number 4. Measure your risk tolerance. Risk tolerance is the amount of risk an investor is ready to accept in exchange for the possibility of a greater return. One of the most crucial criteria influencing the assets you add to your portfolio is your risk tolerance. A risk tolerance questionnaire is one technique to assess your risk tolerance. These are often a brief series of survey questions designed to assist you to understand your risk tolerance depending on the replies you provide. Someone with a more cautious tolerance may invest more of their portfolio in bonds and cash than in equities, whilst someone with a more aggressive tolerance may invest more of their portfolio in stocks. When assessing your risk tolerance, bear in mind that it is not the same as risk capacity. Your risk tolerance expresses your readiness to tolerate risk in exchange for a better return. It is simply a measure of your emotional reaction to losses and volatility. Danger capacity, on the other hand, is defined as the amount of risk you can bear. Risk capacity takes into account the aspects that influence your financial ability to accept risks, such as work status, caretaking responsibilities, and how much time you have to attain that objective. Because these other goals might be money demanding, your willingness to take risks must be congruent with those constraints. Number 5. Consider what kind of investor you want to be. There is no such thing as a one-size-fits-all strategy for investing. Because certain techniques may need a more aggressive approach, the sort of investor you wish to be is closely related to your risk tolerance and ability. It is also linked to your investment objectives and time horizon. Investors are divided into two categories: short-term investment, sometimes known as trading, and long-term investing. The allure of short-term investing is the possibility of replacing your existing income with earnings generated by purchasing and selling stocks. The disadvantage is that seeing regular earnings may be difficult and dangerous due to how rapidly the market can fluctuate and how unexpected news and announcements might damage investment in the near term. Furthermore, short-term investment gains are often taxed at a greater rate than long-term investments. A short-term gain or loss is defined by the IRS as an asset purchased and disposed of in 1 year or less. When an asset is kept for longer than a year, long-term capital gains and losses occur. This video has come to an end. Please make sure to subscribe to our channel and hit the bell icon for future updates. Also, what are your thoughts on this video? Comment down below.